Hi, this is Phil Chandler, and today we're talking about the infamous 2018 Tax Reform Act, or as Congress and I believe the President likes to call it, the Tax Cuts and Jobs Act. Made a lot of changes. Did it simplify anything? Heck no. It was pretty surprising when the President first came out with this thing trying to drum up support. He was talking about how it was going to end up on a postcard, and I think it was pretty obvious, at least to a lot of us tax professionals, that basically knew there was no way in the world that was ever going to happen, and obviously it didn't do anything. So is it good for everybody or is it bad for everybody? And the answer is it depends. No big surprise there, and I know that I get that question on a regular basis from my business tax clients as well as my personal tax clients, and it really just depends. Well, first off, we know the big picture. We don't know a lot of the details, because even though the act has been passed, there's a lot of details in that 1,000+ page documents of tax revisions that really need to be interpreted by the IRS before it really comes into play. So there's a lot of stuff that we simply still don't know, and we won't know probably until December of this year, 2018, before it kicks into place for the following year. So what I want to do is talk about the big picture. Let's just look at the big items that a lot of people are talking about and not get into the details, because I think it's important that most people understand the basics, whether you're a personal tax return and especially if you're a business owner, because it definitely dramatically changed some business aspects of taxes. But let's get into it, do it a step at a time, and just look at some of these items, all righty? So the first thing, let's look at the tax bracket itself. And we start out by looking at the single taxpayers, because we'll jump from that into the married filing jointly taxpayers. But I think this kind of gives you, just in a nutshell, a brief idea of how it changes the bracket wise. And as you'll see in the lower brackets, not a lot of big changes, but as you get higher and higher, it has a little bit more dramatic changes. So let's just stare at it a little bit here. In the 10% tax bracket, which is the lowest one, there's still a 10% tax bracket. It was $9,300 on the top part of it. Now it's $9,525. Not a big difference. And first off, I want to point out that there are 1, 2, 3, 4, 5, 6, 7. There was 7 tax brackets, and hey, lo and behold, there's still 7 tax brackets. So it didn't change that at all. They started out reducing it, and to me, that was never really a fix, because it's not a matter of what the bracket was. It's a matter of how much income was squeezed into those brackets. That's really what it comes down to. But let's move on. So on the second tax bracket, it was 15%. Now that's 12%, but it was $37,000. Now it's $38,000. Not a big difference there. The third one, 25% tax bracket. Yeah, I got tweaked down to a 22%, but it was $91,000, now $82,000. Still, not a big change overall. The next one, 28% tax bracket, was at $191,000, the high end of it. That's what we're looking at. That tax bracket has been lowered, no doubt about it, to the 24% tax bracket, and it's $157,000. But here's where it's hard to just start comparing before and after, because things are just moving a little bit. It's a lower tax rate, but it's a higher bracket, and that's where we see right here. 33% tax bracket includes everybody all the way up to over $400,000 of income. And yeah, the bracket went down 1%, but the amount of money that's included in that bracket only goes up to $200,000. That was pretty surprising to me, actually. And then the 35% is at $418,000, which is kind of ridiculous. It's only a couple $1,000s difference. And 35% tax bracket, same one, includes $500,000. So here again, not a lot of changes. It just shuffled the deck a little bit. So let's jump over to married filing jointly. And that's pretty much not a big difference in what we just saw in the single taxpayers. It kind of doubles the numbers. Obviously, there's 2 people, 2 income streams, which is what that's based on. So not a lot of change. 10%, $18,000, now it's $19,000. The 15% tax bracket was $75 at the high end, now it's $77, not a big difference. 25% was at $153,000 on the high end. That came down to 22%. but it went up on the 165,000, so a little bit higher bracket on it. 28% is now at 24%. Same kind of numbers. They're kind of just shuffling around a little bit. It's hard to just compare these dollar for dollar, obviously. 33% tax bracket was at 416,000. Now, pretty much the same bracket. 32% is a little bit less, 400,000. And then the 35% bracket at 470,000 was now at 600,000. So here again, is it good for you or bad for you? It depends. It depends on who you are and what your earnings and whether you're single or married. But let's look at something that has just as much impact and to me is a little bit easier to kind of put your hands on as far as how it changed it. So first off, let's talk about standard deductions. Everybody on their personal tax return has a choice on how their taxes are reduced, on the deductions. You can either use standard deduction, the higher of it, standard deduction, or itemized deductions, which is that Schedule A. Itemized deductions on Schedule A includes things like your health care deductions, your property tax deductions, your mortgage insurance deductions, your charitable donation deductions, unreimbursed business expenses. That's the main items. So every year you look at itemized deductions, you compare that to the standard deduction, and you take whichever one's higher. Makes sense. You don't have to, but most people would because you want more deduction. That's better for you. So previously, the standard deductions for a single person was $6,300. For married was $12,000. Well, they doubled that for all practical purposes. So now instead of a single getting only $6,300 deduction, they got $12,000. Married people, instead of $12,000, they got $24,000. That sounds great. What that means is there's going to be fewer people that are going to need to do itemized deductions because it's hard to get to that higher standard deduction level. Makes sense. Not necessarily a harmful thing one way or another. But the other component of that, which a lot of people are missing, is that even though they raised the deductions, the standard deductions, they eliminated the exemptions. And here's how that works. Every person on your tax return gets an additional deduction, used to, an additional standard deduction or exemption per dependent. So in other words, if it's just you, you had a $4,000 exemption deduction. If it's you and your wife, you get $8,100. If it's you, your wife, and 3 kids, that's 5 people in that household. 5 times $4,000 is over $20,000 worth of exemptions, which is additional tax deductions. But look over on the tax reform plan. That's been eliminated. So if you're a single person, your standard deduction went up by $6,000. Your exemption got eliminated, which means you lose $4,000. So you're to the better, granted. Now we're not talking about whether you itemized or not. But let's say it's a couple with 3 kids. A couple with 3 kids means you have 5 exemptions. So if you're married, your standard deduction went up roughly $12,000, but you just lost over $20,000 of exemptions. So you will get hurt on the tax reform plan. Now here again, I'm not talking about itemized deductions because that's separate, and child tax credit, which gives you a credit for any of your kids under age 17, did go up. So there is some offsetting of that. And I think that's just a great example of, did it help or hurt people? It did both. All it did was, but the most part, it just changed the rules. And some people got better, some people got worse. So I don't know if this is a good thing or a bad thing for on the tax reform. It certainly helps us. I mean, tax preparers, it did not simplify anything. So let's go further into this. Let's look at some of the main personal tax return changes in addition to the standard deduction and the exemptions that went away. So first off, they lowered the medical expense floor from 10% to 7.5%. So what does that mean? Well, medical expenses, if you had a bunch of them, those are one of the things that are on your itemized deductions on your Schedule A. So if you're using standard deduction, it really doesn't make a difference. If you have somebody in your family that's really sick and really racking up the bills, there's a good chance that there's going to be enough medical expenses to where you need to itemize. So this helps that in a sense of, it used to be, let's say, adjusted gross income. That's a terminology that says pretty much all the household income, adjusted gross income for the house. So before you could write off $1 of a medical expense, you had to have enough medical expenses that equaled 10% of your AGI, your adjusted gross income. That's pretty hard to do for a lot of families, for most families. Now they've lowered that from 10% to 7.5%. Is that a good thing? Yes. Does that make a difference on a lot of tax returns? It depends. Here again is a lot of times somebody has to be really sick to be racking up a lot of bills before they can even start writing off the first dollar for medical expenses. So it's been lowered, so that helps. On a side note, what I mentioned on there is health insurance mandate, which is the one where basically if you don't have health insurance for at least 9 months out of the year, you're getting penalized by the government. The one that everybody just loved to gripe about. Well, that's been repealed, not in 2018, certainly not in 2017, but starting in January 1st, 2019, that mandate is now being eliminated. So that'll be good for some people. They've reduced the itemized deductions of state and local taxes to $10,000. So here again, itemized deductions on your Schedule A. One of those deductions, in addition to medical expenses, was you got to write off sales tax and property taxes on the properties that you owned. Now they're limiting that to $10,000. So that's not a good thing for trying to come up with a bunch of itemized deductions. Makes a difference on whether you're in a state like mine where it's Tennessee, not really high property tax, versus someplace like Connecticut, New York, where you have very high property taxes. They're going to get hurt worse than somebody in Tennessee or Texas. Mortgage interest deductions limited to $750,000 mortgage, so they lowered that a little bit. Home equity line of credit, the interest on that used to be deductible. Now that's eliminated. So they've made it a little bit tougher to get a high enough itemized deductions on those two items. Alimony payment deduction, granted that there's a lot of divorces, so there's a lot of alimony flowing out there. The way it used to be is that whoever paid alimony got to deduct it. Whoever received alimony had to report it. Now they've eliminated that deduction. Is that a good thing or a bad thing? I don't know. It depends on who you are, whether that's good or bad. Moving expenses deduction, that's been eliminated except for the military. That would come up every once in a while with my tax clients. I hated to see that one go away. Here again, that has to do with itemized deductions. So if somebody had a major move to get a better job, and it's usually a one-time event, then that was nice to be able to deduct some of that. So I think it's a shame that they took that away. And then the last item I mentioned here is child tax credits has been increased from $1,000 to $2,000. So that did go up. That helps a little bit to offset that removal, that elimination of the exemptions. So that's some of the main personal tax return changes. There's a number of other ones, but I think these are the main ones that a lot of people are familiar with or interested in. So that's on the personal tax returns. Now the other one, and I think it's almost more important, and the one really that President Trump is really talking a lot about, is the business tax reductions. First off, there's two categories here. One is the big companies, which for all practical purposes is C corporations, the public stock traded companies, C corporations. They reduced their tax bracket from the high of 35% all the way down to 21%. That's major. And there's no doubt that that's going to be a huge benefit to the economy in the United States. And I think we are already seeing companies that are going to be moving back to the United States that might have been looking at other countries for favorable tax benefits. So that was huge. And that will be great for anybody working for large companies. They should be. In addition to that, one other side note is the C Corporation alternative minimum tax was repealed. That was always a complication that it was almost like you had to do 2 tax returns in order to figure out what the taxes were on those companies. So a C Corporation who pays its own taxes, those tax brackets, that tax rate went down dramatically from 35 to 21%. But when they did that, of course, the big question was, all right, what's in it for the small business owner? And when I'm saying small, I mean lower than $10 million. So it's not just the mom and pop type businesses that we're talking about, but for the partnerships, S corporations, sole proprietors, single member LLCs, which are called self-employed owners, all of those got another benefit because the C corporations, they had a huge tax reduction. So this was the offsetting assistance to the small business owners. So anybody that has a partnership, an S corporation, a sole proprietor, or an LLC, single member, the way these businesses pay taxes, those businesses do not pay taxes directly. Whatever the net income is, whatever the taxable income is on those businesses, that flows to the business owners, and then they report that on their personal tax return. So that's called a flow-through entity is what that means. So what the tax changes are now, starting in 2018, is that when a business makes a certain amount of tax income, before that gets reported on a personal tax return, it gets reduced by 20%. That's huge. That's a big thing. So let's just take, for example, a business makes net income, taxable income of $100,000. So that $100,000, if there's one business owner, would flow to that business owner on his personal tax return. But now, instead of putting $100,000 income on there, it's going to be $100,000 less $20,000, 20%. So now he only has to report $80,000 taxable income on his personal tax return. So it's a different way of lowering taxes. Here again, it didn't simplify anything. And to add another complication to it, there's a whole different set of rules for flow-through entities that are service organizations, such as accounting firms, lawyers, and things like that. People that provide a service where the majority of their expenses are payroll, including themselves. The tax changes really complicate that one because they limit that 20% based on how much payroll there is in that business. So I don't want to go into that one because that's a whole different video, really. But suffice to say that taxes have been reduced for the business owners that have flow-through entities, and I think that's great. So I'm pretty excited about that. I'm very excited about that one. So the conclusion, is the Tax Reform Act an improvement? It depends on what your tax bracket is, on how many people are in your family, on whether you own a business or not. Has it simplified anything? Heck no. It didn't do anything but shuffle the deck, change the rules. I think overall there's some benefits here, especially for businesses, without a doubt. But for a lot of just plain old individuals like myself and you, it really depends on who you are. Take care. Appreciate it. Bye-bye.